Welcome to Rush Hour. I am Ankur Mishra. Let's get started with the news on economy. Organization for Economic Cooperation and Development raises India's FY26 GDP forecast to 6.7% while cutting inflation estimate to 2.9% for FY26. Remember, Reserve Bank of India still has a projection of 6.5% GDP target and inflation at around 4.5%. My colleague Anurag Joshi is here with more details on this story.
Organization for Economic Cooperation and Development, the Paris-based Intergovernmental Forum, has raised India's FY26 economic growth forecast by 40 basis points to 6.7%. OECD has cut India's FY27 GDP forecast by 20 basis points to 6.2% and also slashed the FY26 headline inflation forecast by 120 basis points to 2.9%. It has cut India's FY27 CPI inflation forecast by 10 basis points to 3.9%. The OECD said that higher US tariffs will weigh on India's exports sector, and India's economic activity is seen supported by the GST reforms. Higher US tariff rates will weigh on exports, and also separately S&P has said that India will be much harder than the rest of the region when it comes to the US tariffs, and this impact will be harder than expected. S&P has forecast India's GDP forecast to hold steady at 6.5% in the fiscal year to March 2026.
All right, to discuss this news, we have with us Garima Kapoor, economist and Senior Vice President, Elara Capital. Garima, welcome to ET Now. My first question to you is, agencies after agencies have been now raising the GDP forecast for India. Do you think that even RBI will think so in the next monetary policy?
I assess that RBI would like to wait out to actually see how the festive season pans out and also to basically assess the impact of tariffs because remember the 25 plus 25% tariffs that have been imposed on Indian exports, the impact of that is yet to play out because a lot of exports were front loaded in anticipation that the deadline would be met. So in my view, while the chances of an upgrade are ripe, especially after the quarter 1 7.8% print that India got for GDP, I would assess that they would like to wait it out before declaring the same unless they have a clarity on how tariffs are panning out.
Right. As far as inflation is concerned, now that is something which has been under control from Reserve Bank of India's side. Keeping the economics in mind, keeping the GST announcements in mind per se, do you think there will be inflation pressure? And even the OECD reports talks about it. What is your assessment on inflation front? RBI assessment is 3.1%, beg your pardon.
So RBI's assessment or projection of inflation for 3.1%, that is CPI inflation, is likely to get undershot by at least 50 basis points, if not more. Our own estimates for FY26, taken into account even a partial pass-through of GST rate cuts, assess that inflation, the headline CPI inflation this financial year will be less than 2.5%. So I see a higher probability of a downward revision to CPI estimates of RBI, given that now there has been a persistent undershooting of the numbers given what RBI projected, and do GST rate cut even at a partial pass-through indicate that a downside bias remains significantly high.
Right. While OECD has raised its forecast, S&P is maintaining that tariff has hit India higher than expected. What is your assessment on that front? How much of the impact tariffs is going to have on the GDP growth of India?
See, the assessment has to be distinguished between the fact that once the first 25% came through, anything above the 25% was insignificant because there are certain sectors, particularly labor-intensive sectors like textiles or gems and jewelry, that become uncompetitive even at 25%. So 25 plus 25, the next 25 really does not matter significantly. The competitiveness is already lost in first 25%. Our assessment, especially taking into account the sectors that are likely to be significantly hit, assuming that there is no resolution of India-US trade deal or negotiations, then we're looking at, including a second round impact, an impact of about 75 to 80 basis point on headline growth. But having said that, the GST-led reforms and the measures that the government has taken this financial year, particularly starting from the tax rebate, now the GST, along with persistently undershooting of inflation, mean that consumption is likely to see a strong rebound. So we do think that the expectation of consumption rebound, parts of which are already started to show up in initial numbers for the festive season, indicate that you will be more than able to mitigate the negative impact of tariffs. So net basis, you're likely to see a growth which is closer to the handle of 7%, especially since the quarter one was 7.8%, thereby negating the impact of tariffs almost completely.
I also want to understand with you, particularly as you were mentioning about the GST rate rationalization impact. Now, on one hand, government has expressed that 48,000 crore is the hit which economy may take. But on the other hand, as you mentioned, the consumption may mitigate the impact, and overall, there may be other measures which will be taken by the government. So overall, the 7% growth story, as you are saying, is possible. Which are the sectors which are going to contribute to it?
See, clearly, currently is a time to play the consumption theme very emphatically. Remember, this country has been devoid of a significant consumption uptick, especially after the COVID wave came into India. And last 2 years particularly have not been very good even for the durable space. So I think currently is the time to play the emphatically the consumption pace. Within the consumption space, we have a preference in the sense that we prefer a premiumization story more than an entry level consumption. Second, we also prefer that this consumption cycle has to be played more materially through intermediates or tertiary level players like lenders or platform companies rather than playing it through OEMs, given that India's consumption basket and consumer preferences changing very quickly. We also continue to believe that given the tailwinds that India is seeing in terms of rate cuts, liquidity, and now consumption, there is a clear-cut story in becoming overweight in BFCs, particularly your large lending financials like Bajaj Finance.
Right. As far as the growth story of India is concerned, there was one roadblock which has been talked about in the recent past is the private capex. Now, with the GST reforms also being in place, do you think this roadblock may be cleared in coming 6 months to 1 year? What is your assessment on that front?
See, the private capex in India struggled to take force despite the front loading of government expenditure, and we failed to see crowding in for two, three factors. One, there wasn't any clear signals of a strong consumption rebound that would mean that utilization levels are coming to a long-term average, number one. Number two, the global backdrop has not been very particularly supportive. Although you have not seen any negative shocks in the global economy, China led supply chains and the dampening effect of dumping of China meant that the visibility was not there. And third, ever since Trump came into power, tariff led uncertainty on global backdrop, especially export oriented sectors, meant that the headwinds only increased. Now, how can you break out of this particular logjam? The way to break out of this logjam, since you do not have control over the external sectors and what happens in the external side of the economy, particularly the US-led tariffs, and consumption boost, which remains durable in nature, can help to sustain an improvement in capacity utilizations that can finally work its way through a private capex coming on board. But because we see this happening over a period of time, especially backed up with a pay commission payouts that are likely towards sometime in next financial year, we think private capex uptick is more formidably a story of FY27 rather than FY26.
All right. Thank you so much for taking out time and joining at this hour.
Thank you.